second part of chapter 1. Now, this part of the chapter is very important. It is vital that you understand the accounting equation. And if you might notice, I'm still taking notes on the same page, and I'll just post it up as chapter 1 notes when I'm done with all the videos. Okay, so the accounting equation is assets equal liabilities plus equity. Okay, very important that you know this. We will use it throughout. In chapter 1, we'll do a lot of things using this accounting equation format. However, we'll get out of that in chapter 2. So you'll only see it set up in this particular format in this chapter 1. Okay. So let's talk a little bit about what each of these items are. All right, we've got the 3 main elements: assets, liabilities, and equity. So assets, these are basically things that you own and use in the business. All right, you might notice they have a little bit more technical term for it. They talk about it as being an economic resource, expected to benefit operations in the future. Okay, so it's something that you have in your possession that you can use. All right, so different types of things or examples would be cash, is of course a big one. Cash, merchandise inventory. We get more into merchandise inventory in chapter 5. Furniture. I'm going to put buildings in here. Land, equipment. And then we're going to add in other things like supplies and things that you pay for in advance, such as prepaid rent or prepaid insurance. Okay, so those are some examples of assets. All right, a liability is money that you owe to somebody. So basically, assets are things that you have, and liabilities or equity are how you paid for them. All right, if you borrowed the money, then you have a liability. All right, so this is liabilities. This is debt owed to creditors. All right, so it's money that you owe to other people. You borrowed money from somebody else to buy something that you needed. So examples would be an account payable, a note payable, a salary payable. I'm also going to add one in here called unearned revenue, which we'll talk about a little bit later on. All right, you might notice the first 3 have payable in their term. Most liabilities have the term payable in their title, in their account title. All right, but you borrowed some money and you have to pay it back. All right, it's a payable. Up here in assets, one thing that we'll add in as we go along, let me just add it in now, is an accounts receivable. All right, an account receivable means that somebody owes you money and you have the right to receive. So an account receivable means you'll be receiving money. An account payable means that you'll be paying money. Okay? Now, unearned revenue is also a liability that we'll talk about as we go through the next few chapters. It's a little bit different because you haven't actually borrowed money from people, but in this case, they've given you money before you performed a job for them or gave them the product that they bought. All right? So we can't recognize it as revenue. We still owe them something. So that's why it's a liability. Okay, and then equity. Equity is basically whatever's left over. All right, so it's owner's claim to assets of the business after the creditors have been paid. Right? So another way that you could look at this accounting equation, you could say assets minus liabilities equals equity. So it's whatever's left over. And actually in many countries, this is how they set up their financial statements. They have their assets, they subtract out the liabilities, and that leaves you with equity at the end. All right, now, I'm calling it equity. Sometimes it's owner's equity, sometimes it's shareholders' equity. It's all the same thing. All right, it's just kind of depends on how your business is set up. If you're set up as a sole proprietorship, you'll probably hear it referred to as the term owner's capital. If it's set up with corporation, then you'll hear equity, paid in capital, retained earnings. We'll hear some different things, okay? But basically, equity is affected by several different things. All right, equity is increased by owner investments or owner contributions. All right, and revenue. So as the business earns money or earns revenue, that increases equity. And then equity is decreased by owner withdrawals. So if, for instance, you have shareholders and you pay them a dividend, then it comes out of equity. So it's decreased by owner withdrawals and expenses. Okay. Okay, so I shifted over and moved back up to the top, and I wrote the accounting equation out. All right, so we have the assets equal liabilities plus equity. And notice that equity is comprised of these different elements. We have the capital that they already have in there, or their investments, minus any withdrawals, plus revenue, minus expenses. Now, typically, we don't list revenue and expenses out like this under equity. We typically compile them on the income statement, okay? And with respect to the income statement, I'm going to come over here for a second. And we haven't gotten to the income statement, but we will. All right. So ultimately, what we'll find is that the income statement will show revenue and expenses. And that net income is revenue minus expenses. And when the number is positive, it's net income. If the number is negative, then it's a net loss. Right, and we'll get to the financial statements in a little bit. But what we're going to do to finish this off is we're going to run through some transactions and show how they affect the accounting equation. Okay. Now, this business or this book uses Sheena Bright, who owns Smart Touch Learning. All right. So we're going to talk about each piece of the transaction. This is where I wish we were in class and you could actually ask me questions, because it would work out better that way. But please be sure to text me if you have any questions about anything. Actually, let me move over one so I can put the date. Okay. All right. Transaction number 1. Actually, I'm just going to put number 1. Sheena Bright contributes $30,000 cash to start a new business as a sole proprietorship named Smart Touch Learning. So Sheena Bright, who's the owner, put $30,000 in an account for the business. All right, so basically when she puts that money in an account, the asset that's created is her cash, all right, her cash account. So she put $30,000 in, so we've got $30,000 in cash there. Now she contributed it, so you're going to come over here under capital and you're going to have $30,000 here. So now I've got $30,000 on the asset side and $30,000 on the liability and equity side. So it balances out around the equal sign. Okay. let's see what she did next. We're just going to go through these one by one. All right, in the second transaction, Smart Touch Learning purchased land for an office location, paying $20,000 in cash. All right, so land is something that the business has and uses, so it is an asset. It's increasing, so it's going to go up by $20,000. Okay, they paid for it with cash. Cash is an asset. It's going down, so you're going to have minus $20,000 there. All right, notice this whole thing took place on the asset side. This nets out to 0. I have 0 over here, so it still balances out. All right, each individual transaction has to balance out around the equal sign. All right, number 3. And you'll notice they're balancing theirs out after each individual one. I am not doing that. Smart Touch Learning buys office supplies on account, which is a liability called accounts payable, agreeing to pay $500 within 30 days. All right, so Smart Touch Learning bought office supplies, which is an asset. So I'm going to, let me shift this one over. You don't have to shift it over. I'm just kind of trying to keep it in order. So I'm going to have office supplies. It's an asset. It's increasing. They cost me $500. I haven't yet paid for them. I owe for it. So I'm going to have to pay, and that is an accounts payable. Oh my gosh. So there's 500 there. All right, so I have 500 on the asset side, 500 on the liability and equity side. So all looks good. All right, in transaction number 4, Smart Touch Learning earns service revenue by providing training services for clients. The business earns $5,500 of revenue and collects this amount in cash. So cash is an asset. It's going up because they received cash. So they got $5,500. All right, and they earned it, and it's revenue. So if you can come over here under equity, remember we have this revenue column, and it's going to be 55 over here. I have 55 on the asset side, 5,500 on the equity side. All balances out. All right, transaction number 6. Dude, is this the next one? Okay, what they have down here does not seem to match what's right here. So I'm going to tell you what they did though. If you look right here on this number 5, they have accounts receivable for $3,000 and revenue for $3,000. So what really happened is they earned revenue, but they earned $3,000 on account. And what that means is the people have not paid them yet. But we recognize revenue as we earn it. So when it's earned, we're going to have a plus $3,000 under revenue. They haven't paid us yet. So what I have to do here is create an accounts receivable. Okay, because I have the right to receive that money. They need to pay me. So I'm going to have accounts receivable for the $3,000. So I have accounts receivable for 3 on the asset side, revenue on the liability and equity side for $3,000. So everything balances out. All right, so they did their thing down here correctly, but they didn't change the wording. So watch out for that. All right, in transaction 6, Smart Touch Learning paid $3,200 in cash expenses, $2,000 for office rent, and $1,200 for employee salaries. All right, so cash is an asset. It's decreasing, so I have minus $3,200 in the cash side. And then office rent and salaries are both expenses, so I'm going to come over here under equity, and I'm going to have minus $2,000 because it decreases equity, and I'm going to keep it in one column, and I'm just going to put rent expense over here. And then I'm also going to have minus $1,200 for salary expense. All right. Transaction number 7. Smart Touch pays $300 to the store from which it bought the office supplies. So it's paying $300 to this accounts payable balance that they have. So this is my transaction 7. Cash is an asset. It's going out the door. So I'm going to minus cash for 300. And then it's going to be minus 300 from the account payable, which is on the liability and equity side. So minus 300 equals minus 300, and it's fine. All right. Number 8, they collected $2,000 from the client from transaction 5. So that's this $3,000 that's owed to us, and they collected $2,500 of that. All right, so they collected cash of, $2,000. They collected cash of $2,000, and it's coming out as accounts receivable, so it's going to go down by $2,000. Notice that everything took place on the asset side. I don't have to worry about anything on the other side because this nets out to 0. All right, and then Sheena withdrew $5,000 cash from the business. They have quite a few typos in this little PowerPoint, don't they? Sheena, the owner, withdrew $5,000 in cash from the business. All right. So cash is an asset. It's going down. So minus 5,000. And then she withdrew it. So that's going to come out of equity. So minus 5,000 here. And I think that's it. All right, so then the next thing to do is make sure that everything balances out. Notice they made sure both things balanced out. So let me do that. Oh, you know what I did do that I shouldn't have done? I need to shift these guys down. And I also need to move this one down. Okay, so I'm going to draw a line under everything. I really want y'all to work in Excel and get very familiar with Excel and how to insert lines. All your homework will be done in Excel. So you need to really be practicing with it and how to do it. All right, so I've got some lines. I'm going to total these out. So I'm going to do equal sum. Block it going up. Then I can actually just copy it across. Actually, I can go all the way across. I just don't need one right here because that's the equal sign column. All right, and then I want to make sure that each side is the same. Oops. And yes, I have 30,500 on both sides, so I'm good. Now I'm going to make all these. I'm not going to make them all dollars. I don't think we need the dollar sign every time, but I am going to make them the number sign or the comma with no decimal places because that looks better. Okay, so I'm going to stop there on that one, and I'm going to do one more video that has the financial statements.